Hey, Andrew, welcome to the show.
Thank you so much. Great to be here.
Yeah, so before we get started, I always like to ask if you can give everybody a little bit about your background and the position you are, in today.
Oh, sure. I went to business school. When after I was as I was getting ready to look for jobs at business school, I got tapped to go talk to sort of a very, very well-known hedge fund manager. And I sort of went into the hedge fund industry by accident. So about 30 years ago, believe it or not. And ended up working for this guy, and then kind of going off and doing things on my own. I started a couple different hedge funds, but really, what my partner and I spent the past 15 years doing is, some of the stuff that hedge funds do is great, but it's inaccessible. It's expensive. Sometimes you think you found the star player who ends up blowing up on you. So, could we find ways to make investing, getting the benefits of hedge funds without a lot of the headaches? Could we do that in a comprehensive way? And so today we manage about $2.5 billion, which is entirely in ETFs and mutual funds in the U.S. as well as their equivalents in Europe. And we're really focused on most of the people that we talk to are wealth managers and people who build model portfolios who are, trying to figure out, we're going from 60-40 to 50-30-20 or something like that. What do we do? What are the tools that we can do to help manage that transition? And so, that's what I spend my waking hours doing.
That's great. And I want to talk about the kind of new model from 60-40 here in a bit. But before we kind of get into all that, I also like to ask any hobbies outside of when you're not kind of behind the screens, or as we were just talking, traveling around and seeing clients.
So I have one all-consuming hobby today who happens to be 2.5 years old. So I was married for a long time. I have two daughters in their mid to late 20s, and now, to everyone's shock, I also have a 2.5-year-old boy. So my days, I used to have hobbies. Now I'm in a horse race with him to see who can learn farm animals and Russian faster. And his mother's first language is Russian. So my days are working 12 hours doing things like this and then playing with cars. So.
Yeah. Well, you and I are in the same boat. I have a 2.5-year-old as well. And it is
Oh,
like,
wow.
it's like trying to, stop water coming out of a fire hose, it seems, at some point. They're wild.
They're wild, and I absolutely adored raising my first daughters when they were young, and I've been very lucky. My work schedule has always been very flexible in terms of time. So, but it's interesting having a son and being older. It's sort of an everyday reminder of I'm sort of more seasoned and mature. Things that would have freaked me out, many years ago don't freak me out as much. On the other hand, boy, it's tiring. So.
Yeah. Well, I think you slightly touched on this in your intro, but can you just kind of provide a high level of the firm itself, like what all you guys do?
Sure.
I know you have a handful of products and you do many different things, so it'd be helpful to kind of just get an overview on the firm as a whole before we jump into DBMF.
Yeah, so what we do is really simple at its core, which is, we kind of look across the hedge fund world and say, A, what do hedge funds do that we like? And B, can we copy it cheaply? There are a lot of things that hedge funds do that we like that we cannot copy cheaply. And so, if you like that as well, then you have to go invest in real hedge funds, and you have to have a lot of money and do all sorts of other things. What we do is it's technically called something called hedge fund replication. And it's one of these disruptive ideas, because a lot of the people who were there during the growth of the hedge fund industry promulgated all these myths about hedge funds. Like, oh my God, this guy's the best. He's the next Warren Buffett. Well, there are a lot of guys who looked like Warren Buffett 10 years ago who you don't even know about today. And what we do only works in a few limited circumstances. And so we're very, very unusual in, and by the way, the way we do it is it's quantitative, right? So we use these risk models to take these complicated portfolios and basically distill them down to something that's very simple and easy and investable. And if we can do that, then we can deliver it to you in a low-cost ETF or mutual fund, et cetera. So the way that we're set up in general is we like managing portfolios. We like doing research. I like doing stuff like this. And then in all of the products that we manage, we're managing it for another firm who's who's in the business of building these products and running distribution teams, etc.
Yeah, that seems to be the hardest part about this is the distribution teams. But speaking about research, I read a really compelling piece on your website about 60/40 portfolios. I know we wanted to touch on this. I think advisors who listen to this show would appreciate kind of learning about how that 60/40 portfolio kind of coming out of the great financial crisis with interest rates at lows, at all-time lows, how that was, and also volatility being lower, how that was kind of an abnormality for really good performance in 60/40. And I kind of wanted to pick your brain about what you think, asset allocation is going to look like now in an environment with, rates being a little bit higher, maybe volatility being a little higher, bonds doing what they did in 2022. So you kind of hinted at it, but kind of what do you think asset allocation should look like kind of going forward?
Sure. Well, so in very simplistic terms, I've thought of the U.S. wealth management industry as being divided into kind of two camps. One camp is the vanguard, robo-advisor, academics who look at it and basically say, do the simplest, cheapest thing that you can. Don't touch it, don't look at it, and go away. And then there's everybody else who says, we think we could do better. We can bring, because, and again, going back to the core principles, every asset manager has the same goal. Every wealth manager has the same goal, which is you want your clients to be happy. Now, and clients can look at us and the fund selector can say, oh, we're happy because you guys have done better than this or the other things. But I think when you're talking about the wealth management space, clients are happy when they feel like their money is going to grow. It's safe. They can sleep at night. The decisions, this impacts their lives. This isn't, the spare billion of Elon Musk's portfolio that if things go down 20%, it has real world consequences for them. And so the irony was a lot of the most sophisticated guys in the space were out there building these more complicated portfolios for a long time. And the simple stuff was just beating the pants off people for a long time. But that was unusual because when you take a step back, Warren Buffett has this great expression where they say, if you didn't have Berkshire Hathaway, what would you do with your money? And he said, well, I'd put 95% into the S&P 500. I'm not going to try to imitate his voice, although I'm really tempted to. But you put 95% into the S&P 500, put 5% in cash, and basically then implicitly don't look at it, right? But when money matters to you in your lifestyle, having a 40 or 50% drawdown, is not something you aren't going to look at. So so all asset allocation is really designed around how do we bring down the risk without bringing down our returns as much. And that's where you get into diversification. Now, on our website, to me, what's fascinating is you can have a dividing line between 2000 through 2020, which is where most people in the wealth management business grew up. This is the data that we look at. This is when data starts to get good, and you have Bloomberg and other things, and you can access all sorts of different kinds of data. And during that period of time, starting with stocks starting with stocks and saying, what do I want to add next to stocks? Bonds were the Superman of diversifiers. They when stocks went up, they were just kind of beating so they were not correlated to stocks. They never really went down. The maximum drawdown, during a period where the S&P 500 dropped 50%, then 50%, then 20%, then 25%, they never went down more than 4%. They were returning much better than cash, right? Because if you just say, I'm taking money out of stocks and putting it into cash, after inflation, that's a really bad plan under most circumstances. So they were unbeatable for about 20 years. And what happens is, as this goes on and on, it reinforces the idea that, hey, we were right? We didn't add these other things to our portfolios. And look, 2018 goes by and we're better off for it. 2019, 2020. And then the world changed. And once inflation started to come back, it's like this earthquake across the wealth management space, because Superman has been basically buried in a pile of kryptonite. And now your max drawdown is no longer 3.8%; it's 17% plus. So it's not safe anymore. These things used to never move, right? They had statistical terms. They'd have like a 4% volatility, and all of a sudden the volatility's doubled from there. And the returns have gone down. Right, you've had almost like a decade of lost returns in the space. So so we say it's like these bubbles do make people look like geniuses, but then when the bubble ends, which clearly has been the case in the 2020s, you need a different toolkit. So the presentation, it's on our website, which is dbi.co, which we don't have an M there because if you go to dbi.com, then you end up with David's Bridal and you can go wedding dress shopping. and even though they've gone bankrupt a couple of times, what they wanted for dbi.com was out of our price point. But dbi.co, and it's called the Great 60/40 Head Fake, and it just kind of shows you how this combination 60/40 worked perfectly. And I published it maybe a little less than a year ago, and now again you're seeing kind of the same thing happening. Last month stocks and bonds both go down at the same time. So the evolution is that people now need to look for different things. There's pressure on people to find things. The simplest portfolios aren't working well anymore. And like, I didn't do the research myself, but you can go to great firms like AQR. There's a guy named Dan Rasmussen at a firm called Verdad who, like me, is penalized by being a Harvard grad. But he has done some great research on what happens when inflation remains higher. And one of the conclusions is if inflation is above 2.5%, stocks and bonds are moving together. So your core diversifier, it's not going away. It's just not your perfect solution anymore. And so that's on the sort of the demand side, as people are saying, I need something else. What can I get? On the supply side, particularly if you're an ETF investor, it's been a veritable wasteland of good products outside of that bring kind of hedge fund strategies. So our very self-interested commercial view of the world is that 60/40 moves to 50/30/20, and within that 20, people are going to be looking for straightforward ways of getting exposure to different asset classes they can put in their models and hold for not 2 years but a decade or 2 decades as part of their strategic asset allocation. And we think it's sort of a greenfield opportunity.
Yeah, no, I would agree. I actually will walk into DBMF right now, which is your managed future strategy. I use it in our model portfolios, and it is a great diversifier. And so, can you really explain at a high level, what the fund itself is trying to accomplish, and then we'll kind of go into the impact that a truly well-run managed future strategy can have on overall volatility and return.
Sure. So let's start with what managed futures as a space is. And managed futures, in a sense, is interesting. It's a strategy that's been around for 50 years with a marketing pitch that's 30 years old. Because back in my day, right, at business school, I almost went into the private equity industry. These were, leveraged buyouts, barbarians at the gate. That is not becoming an institutional asset class. Now they're captains of industry running private equity firms.
Right.
That feels better for a pension plan. Asset-based lending was like this knuckle dragging, brass knuckle business of kind of beating up people and taking their assets and stuff. Now it's called private credit. And so managed futures is peculiar in that, as I'll describe it, it has these incredible diversification benefits, but people are still talking like they're talking in the engine room to somebody else who's at that level of detail. And I think when you get into the broader RA world, that doesn't make people feel like they're going to sleep better at night when you talk about the way. So, but what is it that they do? So it's a hedge fund category that's been around for 50 years, basically. And in its infancy, there were guys who would build these computer models back when, not everybody had computers, and certainly you couldn't find price data on something like crude oil or gold. And they would analyze the historical data and say, do we think gold is going to keep going up or down based upon that? And so one of the people talk about is trend following. Now, it's proven to be a great diversifier over time because it marches to the beat of its own drum, et cetera. And there's $300 billion of guys who run hedge funds who do this, and they charge hedge fund fees. It's 1 in 20, sometimes a little bit more than that. So a year like 2022, you add up all those fees, these guys are making 500 or 600 basis points. And everyone's thrilled because they're still up 20%, but it's a lot of money and they're hard to get into. So, but when you take a step back and say, how do I describe this to my sister? My sister is always the prototype, because I was 25 minutes into describing what we do. And she paused me and she said, "What's an ETF?" And I was like, "Oh, whoops."
Sorry.
It's basically, look, we all read the paper, we see what's going on, and we hear about something like, war in the Middle East is going to drive up crude oil prices, and that's going to affect people's driving in over Memorial Day. Well, people who do something called macro trading, those are opportunities for them. If inflation is going to go up from here, if the Fed's not going to cut rates, if the dollar is going to be strong, it's not about whether it's cheaper or better to go on a vacation in Europe or Japan. It's about, can we make money for our clients in that? So that's what these guys do, and they just do it with computer models. And so what we got into the space, we were not managed futures guys, we were not insiders on the space, but we looked at it sitting from your side of the table and said, what do we really want? And what we really wanted was the returns of the overall space, but without a lot of the issues associated with it. So what are the issues? High fees. Okay, well, if we can copy what they do and not charge a lot, it's like going from an A share class to an I share class. You're just going to do better over time. Now, it's not as straightforward as that, but can we package it in the vehicle like an ETF? That means that somebody can buy $25 with it, or they buy $100 million with it. And so our research basically showed that actually this is one of those strategies where, using these sophisticated risk models, we can boil down what these very, very complicated portfolios are down to a handful of what we sort of call big trades or big opportunities. And it's not perfect what we do. It's just the best way that we found of getting broad-based exposure to the space.
So can you talk about overall the benefits of adding a managed future strategy to an allocation? We talked about the 50-30-20 model instead of 60-40, but really, if you're an investment advisor putting this in a model inside their model portfolio, or what is the reasoning for that? What is it accomplishing for the overall risk and return metrics of a portfolio?
Sure. There's the statistical math side of it, right? Which is Nobel laureate Paul Samuelson, great economist, said diversification is the one true free lunch in finance, which basically means that if you can find things that do not look like stocks and bonds and other things over time, and you add it to your portfolio, in general, if you're looking at the next 20 years, your clients will have a smoother ride. And if you pick a decent asset that does that, they should make as much or more money over time. So in statistical jargon, you would say it will raise the Sharpe ratio of a portfolio. Now, when you look at, so for instance, if you look at since 2000 and you said, would I rather have had a 40% allocation to bonds or managed futures? The kind of stunning conclusion is you'd rather have an allocation to managed futures over that period of time. You would have been unhappy with it for 20 years and deliriously happy with it for 4 years. So I'm a little bit of a rogue in this space, in that I think the appropriate allocation for people is much lower than that, because I think people are dealing with the very human considerations of talking to clients in most circumstances. I mean, if you have a model portfolio and clients never look at the line items, then you're very lucky. And but for clients for advisors of clients who stare at line items, I think the value of managed futures is, like any diversifying asset class, is that there are times when it's going to do really disproportionately well. And it's just kind of evidence that you're doing something that's more sophisticated, that is more flexible, more nimble than the robo-advisor down the street who's telling you everything should be for free, basically. And so, when I talk to people about including this in their portfolios, part of it is about, yes, you can make a pitch. So if you had an allocation to this in 2022, the overall space is up 20. I don't think I'm allowed to talk about the performance of the ETF, but you can, obviously we didn't have a bad 22 or we wouldn't be having this conversation. The part of it is basically, I think a lot of people from the statistical side will say, look, instead of having, if you had a 10% allocation to it, you would have done, instead of going down 18%, you were down 16%. I don't think that's a warm and fuzzy client conversation with clients, that you're down 200 basis points less than everything else. I think people are panicked about everything in the news at that point is we're going to have gas rationing in Germany. The lines are falling in Ukraine. We thought the world was going to explode, basically. But what it does do is it shows that this was one of those periods of time where everything's going down at the same time, and you have something that's different. And so there will be periods of time when these assets are your favorite investment, the thing that you want to point to. And there are also times when it's not going to be, right? If the S&P goes up like it does last year and managed futures as a whole went down, then clients don't have to be fair. It's their money. They don't have to say, well, thank you, you did well. And they can sit and say, well, great, I loved owning it in 22. Why didn't you switch into the S&P last year when the S&P went up? And so I think for any allocators looking at the space, there are two parts of this. One is it's, from a statistical perspective, I think it's a no-brainer to have this in your portfolio. But as they say in the family office world, you don't eat Sharpe ratios. So you've got to have a strategy for how you talk about this with clients in a way that fits into your ethos of asset allocation, what you're trying to help them to achieve. Why, in a year when it underperforms, why they should still be okay with that. And that usually is a sizing issue. Yeah, I'm sure you run into this question.
Oh yeah, no, I totally agree. I mean, it's also bringing down variability of return and a lot of those different things. But it's funny, people tend to flood to managed futures after the fact and then get disappointed in the return, because when they should be buying it and adding to it is when things are really good, because the likelihood of the managed futures outperforming during periods of volatility and bad markets is there, and then the event happens, managed futures has their year, and then everybody floods in. That just seems to be what I see as like investment advisor strategy switching, and then the case to be made here though is go ahead.
Well, no, see, I don't see that really from our clients, right? Because I'm very careful on how I talk about this. One is, and I would tell people up front, if you think you can time this, right? There are a million better ways to time. If you think that, you're basically saying, I think I can time when the S&P is going to go up or down, then for God's sakes, just do that, right?
Right.
Just do the S&P. You don't have to go in and out of managed futures if you can predict the future. I think what's going to happen with this is a strategy. I think that was a mismarketing issue. Even there was an expression people use about, it delivers crisis alpha, right? But that implies that you want to, there's a crisis around the corner, and now I want to own it for today, right? This is not there's no crisis this year, and the strategy overall is having a staggeringly good year. The ethos and the description of this has to be a strategic allocation, because you can't get the timing right. Now you can do rebalancings, like at the end of 2022 when this has gone up a lot and everything else has gone down. Of course, you can rebalance it back to some sort of a level. It's as people do with their portfolios with every asset class. But I think if you tell your clients this is a short-term play on some expected move in the markets, they're going to be impatient,
right?
So I think look. Remember when we added REITs? You still have them, right? They go through good and bad periods. We added. Remember, junk bonds were called high yield. We added those as well. We've got muni money markets, or whatever it is. These big decisions that go into adding putting different arrows in the portfolio quiver over time are, by definition, they're long-term in nature. And so what's interesting for us is actually we've had a relatively we obviously have had punctuated periods of very good and bad performance. Most of our allocators are RIAs who have this mentality. And that's why most of my conversations are with people, where I like the conversations I like to have with people who build model portfolios. Because I want to be people's allocation today, but in 10 years.
Right. Yeah. I agree with everything you just said there. I think it's, I guess the point I was trying to make is that the RIA needs to be having the front end conversation with the client about the expectation of the managed futures holding, right? Meaning it could underperform during good periods. It could, right? Sure. And then they want to unload it and strategy chase something that might be tilted more towards just growth, like we saw over the last 2 years. And then they limit their managed futures allocation when they might need it the most. You talked about kind of.
Can I add one thing to that? Because every other asset class, right, has a narrative for why you should hold it long term, right? And it's usually tied to some fundamental metric. Don't get out of equities at the bottom. Stocks for the long run. Like it's, I'm going to get my money back at par as long as I hold it. I don't. So every other asset class has its narrative around it. Managed futures doesn't fit that model well, because when these guys lose money, they'll get out of the positions. They don't hold on. They're not Kathy Wood holding on with a white knuckle grip, hoping it comes back. They're out, right? And they're looking for the new opportunities. Think about this year, the performance this year, the very good performance of the space this year was new opportunities that they weren't invested in 4 or 5 months ago. And as the markets got rocky in April, they're actually taking profits on some of those positions already. And so the underlying dynamism of the strategy, the problem is, though, that advisors often want a simple story, like, the average PE has never been lower for this portfolio. We don't want to be the guys who get out of the bottom. And that's why I think the messaging, as you say, on the front end, is literally just has to be explicit. Like, this is going to be a dynamic portfolio. We think it's going to be additive to your portfolio today, 10 years, and in 20 years. And so you should expect to see this every quarter that goes by. We may not have it in exactly the same allocation, exactly the same size. Your needs are going to change, et cetera. But it's just one more leg of the asset allocation stool. And that's where I think, though, also sizing of the strategy ends up being important, because you're going to have, as the world evolves, maybe you'll have some Bitcoin exposure. You'll have some direct gold exposure, direct commodity exposure. You may have all these different things that you can add into that portfolio, and this should just be one of those, one element of that.
Yeah. So let's talk about the strategy as a whole. Can you talk about, you touched on it briefly, you're kind of using quantitative risk models, but can you talk about the drivers of how you're kind of making investment decisions? Sure. And is that driver kind of fully systematic in nature?
Yeah, so it's 100% systematic, and what we do when we talk about the diversification benefits of the space, it's a little bit like saying, like, if you say the S&P 500, right, it consists of 500 stocks. You can look at each of the 500 stocks. But you're always looking at the category. The category here is an index called the SocGen CTA Hedge Fund Index, and that goes back to 2000 with good data, and it's basically the average returns after all fees and expenses of the 20 largest guys each year. And so that's kind of the best way that you can say is a representation of it. It's not the Magnificent Seven, it's the Magnificent 20 in the space. And so what we do is we basically take recent data, but I mean the past 3-4 weeks of data on that index, just the reported returns, because this index happens to be reported every day. And the first thing we do is we bump up the returns for what we estimate are the fees and expenses. So through through March, I think the index was up between 9 and 10%, but it was really up 13 or 12 or 13 before those fees and expenses. So anyway, we're aiming for the 12 or 13, not the 10. And then what we do is we have risk models, and our risk models don't try to copy what these guys do. Say, like, do we think these guys are going to be owning more or less gold today than they were a week ago? Rather, what the risk model does is says, okay, these guys have lots and lots of different, 20 different funds, each of which has lots and lots of different positions. What are the really big drivers of performance? And the reason, so what the model does is basically we have 10 big liquid instruments that we use. So gold, oil, dollar euro, dollar yen, which has been in the news a lot recently, 2-year, 10-year, 30-year treasuries, 3 equity markets. And again, like them, it's all in futures contracts. But basically, what the model does is say what portfolio of these is our best approximation of how those guys are positioned on Monday afternoon. And we see changes. So, if they've been dialing back their gold position, we'll usually see a dialing, or, dialing back their metals or whatever position, we'll see a dial back in our position. We'll rebalance accordingly. So all we do is once a month, we look at this index data. We try to use a model, totally systematic, to figure out the most accurate portfolio, invest in it, wait a week and do it again. And the reason, and what we end up with is around a 90% correlation to it. So it's not perfect. We do go through, periods of outperformance and underperformance. We don't usually stray that far from it. And again, because we're aiming for their pre-fee returns, but doing more efficiently, we historically, would expect it or have outperformed by 200, 250 basis points over time. But it's a simple portfolio, and we can put into an ETF. So with daily position level transparency and attractive fees.
Yeah, and liquidity. And so you kind of touched on my next few questions, but is there guardrails, or I'm sure there's guardrails on kind of max long and short position sizes. I kind of briefly looked at the holdings. You're long some stuff, you're short some stuff, right? So are there guardrails on that, or can you kind of go wherever the index is telling you to go?
Mostly we put in 2, I don't want to say semi-arbitrary guardrails in the beginning. So, by the way, what's unusual, we started doing this strategy. ETF has been around since May 2019, so May 9th. So if this comes out after May 9th, you'll probably be sick of me already talking about it. But we started the strategy in mid-2016. We haven't changed a thing since we started. Right? It's the same 10 instruments, it's the same, which is very unusual in quant land. But again, our view is, if you come up with a model that's working and continues to work, don't change it. You kind of risk screwing up. Usually when people are like, I made all these great changes to my model, it's because something went wrong. So most of the things that you would worry about, like, are we too concentrated in this asset class versus that asset class, et cetera, is kind of taken care of by the fact that you're looking at the average returns of these 20 guys. Because each one of them has a million different guardrails in it. So the 2 relatively, I don't want to say arbitrary, but guardrails we put in, we didn't want to go more than 20% long or short, either crude oil or gold. And so those are just, written in stone. And the other positions, we have caps on them, but they're not something that we end up hitting. And so so basically, one of the things that was important to us when we were doing it is, often when you're taking a hedge fund strategy, which has a zillion different bells and whistles and lots of complicated instruments, imagine in a normal hedge fund strategy, if you got swaps and options and illiquid assets and other things, you try to do that in an ETF, forget about it.
Yeah.
Right. So part of our ethos of keeping it as simple and straightforward is also geared around the fact that we want to be able to offer this in an ETF. Now, what it means is, when you look at our holdings, and you can see our holdings every day on the website, you're looking at 10 futures contracts. And so you want to know how much, we are long non-US developed stocks through an IFA futures contract. It's there. You can look at it in the morning. What you're going to do with that information, I'm not entirely sure, but you can certainly stare at it. Our competitors who run managed futures mutual funds, and first of all, you can't see what they're invested in every day. And then you look at their holdings at the end of the quarter, it's like 1,200 positions.
Right.
4,000 positions, 6,000 positions. I mean, this is a business that just goes insane over complexity. And part of it is that, there is a buyer base for complexity. A lot of it sounds really, really cool when you hear about it. For me, having been in the hedge fund industry for a long time, like, the best trades are not, it's like what Charlie Munger used to say. Like, if you have to do it to 2 decimal places, don't do it. right? It should be the best stock should be obvious, right? I think Buffett said the same thing, but usually Munger says it first, and then Buffett said it more eloquently. But the but so so for us we really, if we can get to the right answer in the simplest and most straightforward way, that's what we're going to do. Because if we want this to become a mainstream asset class, people have to be comfortable with it. You can't be selling them black boxes and trying to impress them with how smart you are and all the complex things. It's got to be something that they feel is more understandable, and therefore will infer that it's more at least predictable in terms of the outcome of trying to do what it's supposed to do, which is give you exposure to this strategy or asset class in an efficient way.
Yeah, and I also saw on your website as well, you kind of do this presentation where you show kind of how you can get the exposure of the 200 or 300 different futures by just owning a handful, and how they're all fairly correlated when certain instances happen. A handful of different things are going to move in a certain direction, so you don't need all of them. You just kind of need one.
Yeah, and a lot of instruments are also combinations of other instruments, and so it's a cool chart. My partner did it. I had this. I was trying to come up with a metaphor for this, and I came up with planets and moons and stuff like that. And he's like, no, sit down, son. Let me take care of this. And he did this great correlation matrix. And what it shows you is a lot of the things that we think of as the way that I simplistically thought about it is that when we're looking at the recent history of these 100 instruments, they're either going up, down, or flat, right? They're not going in 100 different directions. But if you want to do it in a little bit more statistically subtle way, which is what he did, is you can look at each of those 100 instruments and say, are they combinations of the 10 big things that we trade? And when you look at it, it's about 90% over time.
Right.
So it was really designed to kind of break this argument that complexity is necessarily good, necessarily results in better returns, necessarily gives you different sources of returns. A lot of that is just marketing nonsense.
Yeah. Well, Andrew, I really appreciate your time today. This was very insightful. Like I said, I use managed futures and particularly your fund in a lot of our model portfolios. And this was very insightful, and I appreciate your time. But before I let you go, can you please let everybody know where they can find some more information about your firm and also get information on the ETFs themselves?
Sure. Well, so by the way, I think just before I say that, I think you are at the vanguard, because I think more and more people are just going to be looking at managed futures. It's not I use this expression. It's like it's managed futures was optional for many years. As the world changes, JP Morgan had this expression that when sometimes an asset class goes from optional to essential, I think it'll just be essential. So I think obviously I agree with what you're saying. I'm self-interested to say that. So we have a website which is dbi.co, as I mentioned. I am very available and accessible on LinkedIn, so you can track me down on LinkedIn, connect with me there, and you'll see this. I put out this stuff periodically, so when we do new research, you'll see it there. I'm less active on Twitter. I actually don't think I know my Twitter handle offhand, but if you hang around the people who are more popular, like the Corey Hofsteins and the Bob Elliott's, you'll see me pop up occasionally. I think I have a picture of me and my dog on stage someplace. On the ETF side, our partners, strategic partners, launched DBMF. It's on their website. The easiest way to get to it is dbmf.com. We'll direct you to it. And, I think one of the things to get a feel for what we do is every month we put out these short, not just a series of slides on performance, but also I do voiceovers of it. And the idea is really, this is it's a quantitative strategy. And if I send you a long description of what every position is doing, which it doesn't give you a feel for what it's like to own it and how to talk about it. And so I've been doing now for over a year, and a very surprisingly high percentage of our clients listen to them every month, because it's really designed to be your coach for the next 10 years as to you get on the phone with the client on a Friday afternoon, or you're about to swing a golf club, and he says, "Hey, what happened to that fund over there?" You've got to be equipped to handle those questions. And so, I'd rather you get that information to you in the first week of the month and talk you through it, so you can listen to it in the car or on the exercise bike, than have it show up in a PDF 2 weeks too late. So
right. Well, again, Andrew, thank you so much. Congratulations on all the success, and I hope to have the opportunity to run into you in the future. I'm sure you're doing the conferences and running around at certain events, so maybe I'll have the opportunity to meet you in person.
In between playing with cars.
Yeah,
so
that's right.
Thank you so much. Wonderful to be here, and again, very much appreciated.
All right, thanks, Andrew.